Welcome back, everybody. We're going to talk about liquidity in the banking system, liquidity in the markets, and what that means for you, the consumer, and what that tells us about what's to come. So buckle up, strap in, let's go. So the banking system is flush with cash right now. Banks all around the country, no matter their size, have a ton of liquidity. So what does that mean for you, to the consumer? Typically speaking, banks want to have as many loans as they do deposits, and they monitor that by something called a loan-to-deposit ratio. If the loan-to-deposit ratio is 100%, that means the bank is loaning out 100% of the deposit base they take in. If it's 80%, that means they're only loaning out 80% of the deposit base they take in. Why is this number critical? Well, if the banking system has a ton of liquidity in it, that means there's a lot of depository cash going through the economy, and a lot of people are depositing, and banks can't keep up with the loan growth that they really need to in order to get that money lent out. And for banks, having that net interest margin, or the difference between what they pay you on your depository rates and what they charge on loan rates, that's where the core banking income comes from. There are other types of banking income, auxiliary income, fees on accounts and stuff like that, and charges and all sorts of non-interest income. But for the purposes of banks across the country, that is where banks make the majority of their money. So banks always want to lend out as much as they can. And if the system has been so flush with cash that banks haven't been able to keep up, that is a warning sign, whether we would like to accept it or not. So what does that do? That puts pressure on deposit rates, because what is a bank going to say? How do we temper and push back people bringing us money right now because we can't loan it out as fast as we're getting it in? You lower those deposit rates that you're giving to the end consumer. So the deposit rates that you're getting on checking accounts and saving accounts and other types of accounts are going down because banks are trying to stop this influx of cash coming into their balance sheet because they can't lend it out super fast. And keep in mind too, in this particular economy, banks are also lending out loans at historic interest rate lows, and most of them are not adjustable loans. A lot of them, if not the overwhelming majority of them, are fixed for at least a period of time, whether that's 3 years, 5 years, 7 years, maybe even 10 years. And in the case of long-term single-family loans, it's 30 years. Now, there's some pressure relief valves for banks so they can sell into the secondary market vis-a-vis securitizations. They can sell to the agencies like Fannie and Freddie and clear up those loans at historic interest rate lows. But as rates start to increase in the economy and loan rates increase, banks are going to want to take advantage of that rate increase. And they can't do that if they're strapped down with loans they've made in a low interest rate economy. So what does this all mean for you, the consumer? It means there's pressure on rates for the depository side, for savings accounts to be low, for CDs and money market accounts to be very, very, very low because of all this influx of wealth, this influx of money. And if banks can't lend it out fast enough, that also means there's signs that the economy is slowing down. All this limited supply of real estate, homes, also leads to a limited availability of banks to make loans to buy homes, because not everybody can find a home and get under contract. And while the system is super flush with cash right now, this is usually a telltale sign of when the market starts to shift the other way. So one of the things we know going into next year is we know that there's supply chain issues. People can't sell and move as many products as they once did. That's going to limit the cash in the economy. 75% of GDP is based off of consumer spending, which also means that the economy will have impacts on people being unable to buy things they want to buy due to the supply chain issues. So you have to see this as a legacy fallout problem. And if businesses aren't making as much money because they can't get the product and people who have this flush capital can't spend it, this continues to drive rates down until ultimately what happens? The Fed steps in and says, we need to increase interest rates by a certain number, probably a quarter of a point, to start getting some elasticity back in the economy. All of this is somewhat hypothetical in that we are in unprecedented, uncharted times. But what I will tell you, the consumer, is that your money right now, being held in cash and not invested in an inflationary economy, is likely not going to serve you well, because the value of a dollar is going down. And at its very, very basic concept, if you have a ton of something, supply and demand, the value of it goes down. If you have a limited supply of it, it goes up. There's more demand for it. So Just like buying a product that's in limited supply, if currency is in completely flush supply and everybody's having it and there's this newfound wealth everywhere, it's going to ultimately devalue the currency, and we're going to start to see inflation continue to creep up. We've done a separate episode on inflation. This is not what this is about. This is more about how you see the banking system and how you look at the trends that are in the market today. One of the things that we tend to do as a consumer is we try to tell ourselves that banking is too sophisticated for us to understand. I can tell you as a banker, it's much more simple than people give it credit for. It's not a completely foreign concept to you. The same way your checking account and saving account works for you, you take money in, you put it out to pay bills, the money you invest makes you more money. That's exactly how a bank works. So you need to pay attention to how your banks operate. You need to pay attention to the rates on your bank accounts, on your checking account, your savings account, and your loans. In low interest rate economies, you should have refinanced all of your debt that you have to low interest rates if you have loans that you can refinance. In high interest rate economies, you should try to avoid getting debt or taking out that debt that you got during lower interest rate economies. And you should plan for that now. You should plan for deflation of the value of the US currency in the inflationary economy. You should plan to refinance your positions and make sure that as you go into the next cycle of economy of low interest rates, and you should be investing in things so that your cash is not sitting in a bank earning you low depository rates if you can invest that money in something strategic for you and your family, which has long-term viable benefits. We all know I'm a fan of real estate. That might be your best investment. I love to help people with questions as it relates to banking, as it relates to finance. If you have any, or you want to get into the specifics of how banks make money or how to maximize your banking relationships, please leave a comment. I'll get to everybody that I can. I generally am pretty communicative. If not, send me a DM, just prod me a little bit, I'll get back to you. Thank you so much for watching the content. Feel free to like, subscribe, follow, and share with your friends. We'll see you next time.